Hey everyone, welcome back to Corporate Decoder. Today, we're diving into Onity Group's latest annual report. It's a real page turner if you're into deciphering financial jargon. Let's just say there are some ups, some downs, and a whole lot of moving pieces, but don't worry, we'll make sense of it together. Alright, straight off the bat, this report has some warnings called forward-looking statements. Basically, they're saying, hey, here's what we think will happen, but no guarantees. They cover everything from market disruptions to cyber attacks. It's a reminder that the future is uncertain, especially in the world of finance. Onity sees itself as a financial services company focused on servicing and originating mortgage loans. They're all about helping homeowners and making money for investors. They're working on a mix of strategies, like growing in ways that don't need a ton of cash up front, keeping costs down, and being smart about how they manage their assets. The company has three main areas. First, there's servicing, where they manage mortgages. This includes collecting payments, handling taxes and insurance, and dealing with foreclosures if necessary. This part has two pieces: mortgages they own the rights to and mortgages they manage for other companies. Second, there's originations, which is all about creating new mortgages. Their goal is to generate profitable growth and renew their servicing portfolio. And finally, there's corporate, which covers everything else. One thing they keep mentioning, regulation. Their business is heavily regulated. They're constantly dealing with the Consumer Financial Protection Bureau, HUD, and a bunch of other agencies, plus a whole lot of complex rules. Staying compliant takes a ton of resources, and messing up can lead to big fines and even losing their licenses. It's a real headache, but they say they are working hard at it. They're up against a lot of competition. They have to fight for customers and clients based on pricing, service, and how well they perform. They say big banks with tons of cash are a real threat, and new tech companies are also shaking things up. So they're leaning on their experience, lower costs, and operations in Asia to try and stay ahead. To make their ratings more respectable with partners, PHH, Onity's main operating subsidiary, has been trying to raise their servicer ratings, which are like credit scores for mortgage companies. Ratings from agencies like Moody's, S&P, and Fitch are super important. Good news, Moody's upgraded their ratings for a few categories, and S&P affirmed their ratings and outlook. However, in a surprise move, the Fitch rating outlook was reduced from positive to stable. While those may sound good, Fitch explained that those ratings also take into account Onity's, the parent company's financial standing. One of Onity's biggest clients is Rhythm Capital. It's a large servicing client, and their subservicing agreements are really important, but Rhythm can drop them as a client. Onity has the responsibility to finance the loans even if Rhythm doesn't pay. If this happens, it could hurt their cash flow. The good news is that the agreements have been extended to February 1, 2026. Another major client is MAV, an MSR investment group. A while back, Onity sold its stake in this group to Oaktree. Now, PHH has a deal to be their exclusive subservicer for 5 years, but MAV can still sell its MSRs to other companies after a 6-month lockout that lasts through Sept 2027. Also, Onity needs to make sure that all of its workers are engaged and committed to their jobs. Onity is placing a significant importance on equal opportunity and a non-discriminatory, safe culture at the company. To keep workers engaged, there are affinity groups, mentorships, and merit-based pay. They also take their ESG practices seriously, including a policy on non-discrimination, promoting equal opportunity, charitable activities, information security, and reducing their environmental footprint. Of course, running a company comes with risks. There are strategic risks, market risks, liquidity risks, operational risks, and credit risks. For example, if Rhythm struggles to meet their advance obligations, Onity would have to step in, which could hurt their finances. A lot of people rely on them. Looking at the numbers, their strategic plan to return to sustained profits might not pan out. There's always a risk that new laws and regulations or economic downturns could throw a wrench in the gears. They face a lot of uncertainty in the market and are taking big steps to cut costs. If they don't stay in line with regulatory demands by government agencies, they could be terminated, and defaults could be triggered under our debt agreements, and so they are carefully planning for that and taking it into account on a quarterly basis. That being said, there's no guarantee that it works as they plan, and they may need to modify even more things such as their employee counts. Since we're talking about numbers, Onity uses estimates to value a lot of its assets and liabilities. Things like interest rates and housing market trends can change quickly, which can require the company to adjust the value of their assets. If they don't estimate those accurately, they will face a world of pain down the road. These adjustments can swing their earnings around a lot. So, Onity could lose the confidence of investors and partners if their value guesses aren't that good. The market conditions, including interest rates and overall economic forecast, are things that could cause worry for investors. If these key relationships worsen, a decrease in subservicing income would likely occur, which could significantly impact our results. Operations outside of the US, such as in India and the Philippines, face different challenges, such as changes in government policies or the disruption of its technology systems. Another risk is disruption due to weather events. All these challenges would be bad for business. Originating and selling reverse mortgages can also hurt Onity's reputation, particularly if older customers feel misled. They also have a captive reinsurance company to protect themselves from catastrophic events like hurricanes, but that can be very risky if there are big claims, and the validity of any foreclosure is potentially challenged by the borrower. Finally, if the company issues new stock, it could dilute existing shares and push the stock price down. There are also provisions in their company rules that could make it harder for someone to take over the company, which could limit potential profits for investors. Now, my overall take after looking at the report, Onity is walking a tightrope. They're working hard to stabilize things and grow, but they have to deal with a lot of outside forces, particularly the legal and financial compliance of their operations. They're making some moves in terms of business initiatives that are worth watching out for, but for now there is no reasonable basis to believe the actions are a certain thing. One area for long-term concern is the challenges it is going to face in its Philippines and India operations. It is great they are working to foster local community in those nations, but it would also require additional capital to properly execute for a very uncertain benefit. Valuation-wise, if we assumed they can reliably achieve earnings of around $4.00 per share, a reasonable target price range would be $34 to $40, acknowledging the inherent risks. Overall, I'm leaning towards a slightly neutral take. I don't see a lot of bullish signals here, but they appear stable in the financial sector to continue operating with a plan to return to profitability. I'd advise caution, keep an eye on those interest rates, rhythm, and for the future if you're interested in this stock. Thanks for watching. If you found this corporate decoder breakdown helpful, be sure to subscribe for more insightful financial analysis.